Welcome back, finance enthusiasts. Let's begin this second segment by discussing the tools used by the Federal Reserve Board. Tools of the Federal Reserve Board. To implement its monetary policy, the FRB employs several tools: setting reserve requirements, setting the discount rate, conducting open market operations, setting margin requirements, using moral suasion. Reserve requirements. Member banks are mandated to hold a certain portion of their deposits on reserve with the FRB. By adjusting the reserve requirement, the FRB can tighten or loosen the money supply. Lowering reserve requirements allows banks to lend more, increasing the money supply and lowering interest rates. Conversely, raising reserve requirements has the opposite effect. Changes in reserve requirements have the most significant impact on the money supply. After meeting the reserve requirement, banks seek to lend out their excess reserves, funds above the reserve amount. Funds lent by borrowers may be deposited in other banks, creating a cycle that multiplies deposits, a process known as the deposit multiplier effect. Essentially, the multiplier effect reflects how banks create new money by relending deposits. The discount window. Originally, the FRB was established to support the banking system by acting as a banker's bank during emergencies. The FRB is always ready to lend money to member banks through its discount window. The interest rate charged for these loans is called the discount rate. Borrowing from the discount window injects new money into the financial system, which is expanded further by the multiplier effect. The FRB can influence borrowing by changing the discount rate. Lowering it encourages borrowing and expands the money supply, while raising it has the opposite effect. Changes in the discount rate are seen as strong signals of shifts in monetary policy. The discount rate is the only rate directly set by the FRB. Although mostly symbolic, it serves as a benchmark for other interest rates, like the Fed funds rate. Federal funds. A bank's reserve position, either excess or deficit, depends on deposits, withdrawals, and loan demands. Banks with excess reserves may lend to banks with deficits, forming short-term loans called federal funds. The interest rate on these loans is the federal funds rate. Determined by supply and demand, the federal funds rate is highly volatile because these loans are short-term, usually overnight. The effective federal funds rate, published daily, reflects the average rate charged overnight. While the FRB does not directly set the Fed funds rate, it establishes a target or range. The FRB's open market operations aim to keep the rate within this target. Open market operations. While reserve requirements and the discount window involve public actions, open market operations can be conducted discreetly, with minimal disruption to markets. The Federal Open Market Committee, FOMC, manages the FRB's buying and selling of U.S. government securities in the secondary market. These operations are the FRB's most effective and frequently used tools. They are also the most flexible and easy to reverse. Open market operations usually involve buying and selling U.S. government securities, mainly Treasury bills. However, the FRB also trades government notes and bonds. These trades are carried out through primary government dealers, which are the country's largest banks and brokerage firms appointed by the FRB, buying securities. When the FRB purchases securities through its open market operations, it injects money into the banking system to boost investment and business activity. The FRB pays for these securities with funds that are then deposited into commercial banks. This increases deposits, reserves, and the funds available for loans. As a result, money becomes more accessible and interest rates tend to fall. This process is called easing of the money supply. Because buying securities expands the money supply, it may lead to inflation. Selling securities. To tighten, reduce the money supply, the FRB sells securities to banks and securities dealers. These banks and dealers pay for the securities by withdrawing funds from their demand, checking, accounts. This withdrawal reduces the amount of money available for loans and has a tightening effect on the money supply, causing interest rates to rise. Since selling securities decreases the money supply, it can help curb inflation. Repurchase agreements. A repurchase agreement, or repo, is a contract where the Federal Reserve agrees to buy U.S. government securities at a fixed price from dealers, with provisions to resell them back to the dealer later at the same price, plus a negotiated interest rate. When the FRB executes a repo, it is lending money, which increases bank reserves and eases the money supply. A reverse repo, also called a match sale, occurs when the FRB sells securities to dealers with plans to buy them back later. This short-term transaction absorbs funds from the money supply, tightening it. Margin requirements. The Securities Exchange Act of 1934 gave the Federal Reserve Board the power to set the amount of credit available for purchasing securities. These rules are outlined in Regulation T for brokerage firms and Regulation U for banks and other lenders. By raising margin requirements, the FRB reduces how much money brokers and banks can lend, which tightens the money supply. However, changing margin requirements is a less effective way for the FRB to control credit because it only impacts securities market transactions. Moral suasion. Sometimes the FRB tries to influence bank lending policies through moral suasion or jawboning. It uses the public media or sends examiners to member banks to exert influence. However, its ability to control the money supply using these methods is limited by how much cooperation it can obtain from these institutions. As with any product, when supply increases, its price will decrease. Conversely, if supply contracts, the price will rise. The price of money is the interest rate that lenders charge borrowers. Therefore, as the FRB adjusts the money supply, interest rates must also change. When interest rates fluctuate, the FRB adjusts its monetary policy to influence various sectors of the economy. Any method or tool that adds money to the banking system can be inflationary. Conversely, tools or methods that reduce the amount of money available can be deflationary. The FRB uses its tools to influence inflation and deflation. International economic factors, exchange rates. Interest rate changes impact not only the domestic economy but also international economic activity. If U.S. interest rates are higher than interest rates abroad, foreign investors seeking higher returns may need to invest in the U.S. However, they must first convert their funds into dollars. If an investor plans to immediately exchange currencies, for example, British pounds for U.S. dollars, the conversion is based on the spot rate. The spot rate is the current value of a base currency compared to a countercurrency. The term comes from the fact that it's the price you get on the spot. As demand for dollars increases, the price, exchange rate, will rise. Therefore, higher U.S. interest rates compared to foreign rates can strengthen the dollar. Conversely, a decline in U.S. interest rates often weakens the dollar. Balance of payments. Foreign exchange rates also influence foreign trade. If a country's exports, goods sent overseas, exceed its imports, goods received from abroad, it has a trade surplus. If imports exceed exports, the country has a trade deficit. To correct a trade deficit, the dollar should weaken, making U.S. goods cheaper and more competitive internationally, while foreign goods become more expensive in the U.S. This encourages more exports and fewer imports, helping to balance trade. U.S. importers and consumers prefer a strong dollar, while U.S. exporters, producers, favor a weak dollar. While overall economic activity is crucial when making investment decisions, fundamental analysis focuses on specific company details. It examines a company's financial statements, for example, balance sheet and income statement, product line, management expertise, and industry outlook. The state of the economy also influences a company's prospects. The balance sheet, also called a statement of financial condition, shows a company's financial status as of a specific date. It is divided into three main sections: assets, liabilities, and stockholders' equity. The name balance sheet comes from the fact that the total assets must always equal the total liabilities plus stockholders' equity. The basic formula is assets equals liabilities plus stockholders' equity, net worth. Assets include everything owned by the company, while liabilities are what the company owes. The difference between total assets and total liabilities is stockholders' equity, or net worth. Assets are categorized into three subsections: current assets, fixed assets, and intangible assets. Current assets. These include cash and items that can be converted into cash within a short period, usually 1 year. Examples include marketable securities, accounts receivable, and inventories. Fixed assets. These are used in daily operations to produce goods. This includes land, buildings, equipment, and furniture. Intangible assets. While these don't have physical value, they add significant worth, such as patents, trademarks, copyrights, franchises, and proprietary rights. Goodwill is another intangible asset and represents the amount paid above the fair market value to acquire an asset or a company. The liabilities section identifies the company's debts. Some debts must be repaid shortly, current liabilities, while others are not due for many years, long-term liabilities. Current liabilities are debts due in less than 1 year and are often indicated by the word payable. This section includes accounts payable, amounts owed for goods and services purchased on credit, dividends payable, interest payable, notes payable, and taxes payable. Long-term liabilities are debts incurred by a corporation that are payable in 1 year or more, such as bonds and long-term bank loans. This section represents the company's net worth and shows the shareholders' ownership interest. It includes different classes of stock, retained earnings, and capital surplus. Capital surplus, or paid-in capital, is the premium paid above the par value by investors purchasing shares from the issuing company. Another key financial document used in fundamental analysis is the income statement, also called the profit and loss statement. It shows a company's financial performance during a specific period and details its revenues and expenses. If revenues exceed expenses, the difference is net income. If expenses exceed revenues, the company records a net loss. Components of the income statement: sales revenues include the total money received and billed, though not yet collected, from the primary business activities. Sales are reduced by operating expenses to calculate operating income. Operating expenses cover daily costs like depreciation of fixed assets. Operating income is adjusted for other income or expenses not related to normal operations, resulting in earnings before interest and taxes, EBT. Other income often includes earnings from investments, dividends and interest, and may also comprise non-recurring items like gains from asset sales or losses from business discontinuation. To determine a company's net income or net loss, EBIT is first reduced by interest on bonds, then by taxes. Many professionals use EBITDA, earnings before interest, taxes, depreciation, and amortization, as a cash flow measure, as depreciation is a non-cash expense that reflects the wear and tear on assets. Measuring profitability. The operating profit margin measures a company's profitability calculated as net operating income divided by sales. Another ratio derived from the income statement is the bond coverage ratio, which is EBT or EBITDA divided by interest expenses. This wraps up the series on economics. The final video in this SIE series will explore investment risks. As discussed, some risks stem from broad economic factors while others are specific to individual products. As we finish this segment, please support us by liking this video and subscribing to our channel. It only takes a moment, but it means a lot to us, and it's completely free. Make sure to turn on notifications so you'll be among the first to see the next segment. Thank you.